Good afternoon, everyone. It's 12 o'clock on my watch. Thank you for joining. Really appreciate it. I hope we can share some interesting information with you today. You should see on your screen a poll. Thank you for the participants that have answered the poll already. I just wanted to note that it is an anonymous poll, so nobody knows who. Nobody will know who the responses came from. If I can just ask you to answer these as I go through the next 2 or 3 kind of housekeeping slides. I'll keep an eye on the results. It's just going to give me a bit of an idea of how well or how I can, at what level at least I can share some of the concepts with you. By a show of hands, can you hear me clearly? Can you see me and the presentation? Great. Thank you. So for the participants entering now, please answer the poll. It is an anonymous one. Just gives me an idea of the level I'm going to pitch certain concepts at. Thank you very much. I'll keep an eye on that. But let's start off with the presentation, with the basics, and take it from there. So, who are we? Why should you listen to us? I think you've probably seen this before. I'm not going to stand still for too long here. However, the 2021 Stockbroking Awards is upon us. I think Monday night was the closing of the polls. So we are eagerly awaiting, the outcome, and hopefully, if we've done what we should have done in the last year, we can maybe add 1 or 2 more. What do we do? Well, you know what we do. You can go through that list, but this one in bold, we are looking at wealth management today, as you know already. By the series name, which we'll get to now. These are some, on the right-hand side, are some of our partners that we use to hopefully give you a top-notch or a world-class final offering or product that matches your needs. Just on the series I'm running at the moment, so this is building intergenerational wealth. As you would have seen and as you would know, I've seen some of the names already come in that have joined me on the whole journey. Thank you for that. But for the ones who've missed kind of sessions 1 to 5, they are all on our YouTube site, and you can navigate to it via our webpage as well. So if there's any of these that kind of tickle your interest, you're welcome to go and listen back to those. But just to go through them quickly, what the idea behind it is to tell you what we think a typical journey would be for a client from a wealth management perspective. And we started way back with the building blocks that we need. For example, you need a will and final will and testament. We spoke about estate liquidity and what people sometimes don't realize happens and how to kind of solve those issues. A lot of what we do has obviously an investment undertone. So we stopped there and just spoke about the art of asset allocation, which I suppose some of what we're going to cover today, I will refer back to that. So that's the important one that I think should be added to this one. We had the great retirement annuity debate. Is it the best thing since sliced bread or the worst? And I kind of put 2 hats on there, and I hope you enjoy that, but very relevant, very topical and important, I think. Spoke last month about the active management versus passive management. We obviously know there's a big debate, and it's a very polarized debate always around that, and we touched on a couple of subjects there. Today we are, as you can see, fairly basic, and I'm going to look at the responses now. but in theory, you can see get started with offshore investing. So we're not going to deep delve at all, and also understand that this slots into a bigger wealth series that we are on the 6th installment. So you can already hear there's going to be very much a wealth focus. However, the focus will be to share information with you on a number of topics that I think, or we think, is very important for you to have. Doesn't matter who you talk to about offshore investing or local investing for that matter, because a lot of the concepts apply both sides of our water, but to at least understand these concepts and make sure you can make an informed decision when you are faced with these decisions. All right, that's today, and then next month will be a little bit around structuring. So some of these concepts that you will see today, we're going to unpack a little bit deeper next month in terms of, well, how does this now look in terms of a structure? How do we take this forward into action, both local and offshore? But understand two things. Firstly, everything I've shared up to now and going forward, we're not considering it as financial advice. So you should just please take it as a sharing of information at the moment, because as many people as there are on this webinar, that's how many different solutions there are on this table. There is no one size fits all solution here. We have to understand each and every client in their personal capacity, and they each have their own nuances. Okay, good. Let me just have a quick squiz at the poll. If there's anybody that's still wondering about the poll, it is completely confidential. Zoom allows us to tick an anonymous box. So you are welcome to answer this. Nobody will know what you said, but it's just for me to very quickly at a glance gauge where I can pitch some of the content that we're going to discuss. Good. Thank you very much for that. There's at least one person that said, please speak English only. I thought, well, I'll throw a little bit of a tongue-in-cheek one in there. Thank you for that. Okay, great. I'm going to end the poll. Let me run it for another couple of seconds, but let's start. All right, agenda for today. We have roughly an hour. What do we want to do today? Well, explore offshore considerations. I would like us to go through these agenda points one by one. So we're going to start off kind of slow in terms of background and technical considerations. But once we've done the 6 points on this agenda, I hope that you will have a better idea of some of the concepts. Again, it is, I'm not going to pitch it way at level 1, but it's definitely not an expert session. As we said in the naming convention of this webinar, that is how to kind of start. So I can see by in terms of the poll, I can see there are some people that has walked some way of this journey or put down this path. So some of the, at least on the background and technical consideration side, it might feel a little bit slow, but understand that hopefully you'll pick up a little bit pace later on. So let's get into it. Firstly, why invest offshore? So each and every one, I think, have a different reason. But the big ones are typically you want to diversify your asset base, which we're going to talk about. You want to potentially improve performance. You may have an idea, you've read some social media that you need to improve performance, and that can only be done offshore according to some of those social media posts. And I'm not saying it's wrong or right. That may be one of the considerations. And another one is there are some interesting structures that can give you a better tax better or a lower tax obligation, and we're going to look at potentially one or two of those. All right, but let's jump into the background and technical considerations. Thank you for completing the poll. I'm going to stop it here. I think I know what I got what I needed from it. I really appreciate that. So let's jump into it. This is the world economy in terms of GDP by country, and this, I'm sure there are later facts and figures, but this is 2019, roughly 2 years ago, and what it looks like in terms of GDP. So country size in terms of its GDP. Probably no surprises. You'll see a big USA there. You'll see a big China there. You know, Japan's out there. Germany's quite big. You know, the giants we know, France. So most of it shouldn't be a surprise. And I think you've always heard this 100 times, that South Africa is a drop in the ocean. And just if you haven't picked us up yet on the slide, it is there. And we are roughly 0.4% of the world GDP, the world economy. So we are negligible, to put it politely. If I wake up tomorrow morning and I feel a little bit under the weather, you know, that's more than 0.4% of my productivity that's already dented. So just to tell you, it's very, very small in terms of our investable universe. And I'm going to build on this a little bit, but it's one of the big reasons, and that's been put out there to say, look, South Africa has whatever we have now, 200 and something stocks on the JSE listed. Used to be 400 and roughly 10, 15 years ago. But, you know, open the rest of the world and there are literally thousands and thousands and thousands of options. So there are other opportunities, I think is the buzzword. Just to show you a couple of interesting ones over here. I hope you can see my cursor moving. So Microsoft, 8 Eastern Europe, EU countries, they're bigger. Apple is bigger than half of Russia, and this is in terms of GDP and market cap. The Balkans, Croatia, that area. Netflix is bigger than the 5 Balkan countries. Very interesting, eh? Facebook, bigger than Argentina, and I like this one. Alphabet, Google, bigger than 38 African countries. Luckily, excluding South Africa, we're roughly 350 billion. So just to show you how big, and these are individual companies, right, that just dwarf the GDP of some countries. Let's talk, you can't talk about anything offshore while you are living, or we call it, try and sound smart, domiciled in South Africa. So USD ZAR is obviously the Rand dollar exchange rate. That's just how I write it. And the interest rate differential. Some people call it the inflation rate differential. What do I mean about that? So if you take the risk-free rate of South Africa, and you can choose any one, let's see one of the, let's say the government bond rates or whatever, it doesn't matter. The point is a like-for-like rate. There's some risk-free rate in South Africa and some risk-free rate, usually a treasury bill in the US. The difference between those two is what we term the interest rate differential. So roughly speaking, that is also the difference between the inflation rates. It's sometimes easier to just track the difference between the inflation rates, and we kind of use that as well. So that difference from an economic perspective is obviously a way for me to profit. Let's say I'm a US citizen. I can get, and it's typically 3.5% higher, and that changes from year to year. So, you know, in the late 80s and 90s, when we saw interest rates topping 20%. So the interest rate differential between us and the US, at that point was massive. These days, obviously, now that we have lower rates as well, it is definitely lower. But the point is, if you go, and you can go back as far as you want, but and this principle should hold, and I'll explain it now, but roughly over the past 20 years, we would have seen a 3.5%, whatever that differential is, right? That difference between the two interest rates. We would have seen a weakening of roughly 3.5% per annum. Now, the Latin, there's a phrase in Latin, and if you've ever done economics, you may remember this. It's ceteris paribus, and I'm probably not even pronouncing it correctly. But the point is, I love this phrase, and it's one of the few things I still remember back from my varsity years. But the point, or all that ceteris paribus means, is looking at one differential or one changeable, like the interest rate differential, for example, and leaving the rest of the world unchanged. So freezing everything else and just looking at one thing in isolation, which is an interesting concept in itself, but that's what we're trying to show you here, is just to say, if we only zoom in on the interest rate differential and we take it over a sufficiently long period of time, you should see a weakening of the currency that has the higher interest rate. And in our case, obviously, that's us, right? South Africa. So we should see this inherent weakening, even if we take all other considerations out of the equation, because I can already hear you guys saying, but what about, political uncertainty, the GDP gap, everything, all relevant. But remember my principle, ceteris paribus, we're keeping that constant for now and just looking at that in isolation. So understanding that the interest rate differential, to have the world economy work and to not have arbitrage between countries, this interest rate differential, this economic principle will hold over time. It's the way of the world balancing itself. So we should see it, and if we don't, then either we as strong as the dollar as when we were back in the, what was it, 80s, 90s, or there are fundamental problems in the world economy, which hopefully we'll never see that level of problems. And we need to peg our currencies, etc. But let's not get into that now. The point is, the rand dollar will weaken. The rand will weaken against the dollar over time by roughly 3.5%. And that's just an average, right? And remember, when you think about this point one, understand that the volatility of the rand also plays an effect, and it plays a very important effect. And I'm going to give you one example now. But let's just talk about the rand volatility. About 3-4 years ago, the rand was the most volatile currency in the rand dollar was the most volatile currency pair in the world. It's still up there. I don't have the latest figures, but the point is, and there are many articles. Go and Google why the rand is so volatile, and some South African guys have written very good articles around why that is. But the point is, we have a massively volatile rand dollar currency, and we can go back to 2017. We were at roughly 1180. Last year, obviously COVID related, we had this black swan event, pushed us to the 19s, and today we're all kind of 1480. I don't know where exactly we are today, but the point is, volatile currency, interest rate differential. So you can already hopefully start to hear where I'm going with this. When you look at offshore investments and you have to use those funds in the short term in South Africa, back in South Africa, and you have a sudden change against you in terms of the exchange rate, and suddenly you have to bring money back into the country and you can't wait, a month, a year, 4 years, whatever the case may be, whatever underlying factor was driving the change, then you have to be able to wear it. Because if you took out rands at 19 a year ago because of COVID speculation and the world is going to implode, or South Africa at least is going to implode very soon, and you took out money at 19, and today we're sitting at 14s something, you're literally down 25%, 20 to 25% on your money. So you've made it, you're in losing territory by a large margin. So understand the volatility of the exchange rate. And if that's something, and everybody's different, right? But if that's something you can live with, and it's a volatility that's palatable, to you as an investor, then we're happy to go with it. But in theory, if there's a long enough amount of time, it should weaken over time. But I'm getting back to that a little bit later. Now, second bullet point that I wanted to discuss was offshore exposure options. How do we get offshore exposure? Now, there are a plethora of different ways we can do that. I try to kind of give you 4 kind of broad lines here, just to kind of start the conversation, but there are more. This is by no means an exhaustive list, so there are definitely more, but let's just go through them. So dual listed stocks, or stocks listed here and over in some foreign stock exchange overseas somewhere, is the one. So for example, AGL, we all know AGL, Anglo American, probably one of the best known stocks in the country, has very little South African exposure left. It's all international exposure these days. So you can buy a South African stock and still get offshore exposure. You can do an asset swap. Now, very quickly, what is an asset swap? Large asset managers, let's take AG, Alan Gray there. As an example, Alan Gray is obviously one of the largest asset managers in the country. So whatever their assets and their AUM is, their assets under management, there's a certain portion of that the Reserve Bank allows them to use in offshore markets, so to gain offshore exposure for their clients. But that is only a certain percentage. That's what we call an asset swap. So when you're in, let's say, an endowment with Alan Gray, and you buy an international, let's say, mutual fund, some balance fund somewhere offshore, US balance fund, for example, they make use of their asset swap capability. Now, as the tides are changing and more investors are moving, are looking for options offshore via these asset swap capabilities, some companies, and not all, but the way it's going, we might get to all of them. But at the moment, Signia 91, the old Investec Asset Management, which is now called 91, and Alan Gray is kind of almost full up in terms of the asset swap capabilities. And they're asking some clients to just hold back at the moment, and you may be an investor in one of those companies. Some of our clients certainly are, and they've received those communications. So just understand that an asset swap, although there's a large amount available, it is getting less and less at some companies. And they might change their asset structure going forward and then open it back up again. I'm not sure of the details of each one underlying, but there are ways in which they can fix it. But just to show you that you are not, there's a reason you are on this call, because I think South Africans as a whole are warming up to this concept of offshore investing. Then the last 2 bullet points here, discretionary, direct discretionary, and physical assets can actually be the same one, but I just wanted to split them. All that I'm trying to tell you here is you have post-tax money in your bank account in South Africa, and you want to invest it somewhere offshore. That's direct discretionary, right? So it's post-tax money versus non-discretionary, which is your retirement monies, etc., which you can't do whatever you want. There are some rules typically around it. And a part of this is then physical assets. So, I buy a investment property in London, or, rent it out, something like that. So those are what we term physical assets. So these are some of the options, but I just thought I'll give you some of the kind of definitions we work with. On to instruments. So now I have my money somewhere. I've decided what I want to do now. In what vehicle, what instrument type do I put my money? And unfortunately, if you thought the previous list was long, this list is massively long. So, I've already mentioned endowments, stockbroking account, banking accounts, etc., etc. There are so many, trusts, international trust, etc. There are lots of instrument types you can use offshore, and then you have to decide what you put in it, right? So, do I put a share portfolio in it? Do I put a ETF in it? Do I put a mutual fund or a unit trust, as we call it locally, in it? All those decisions you will have to make. So just back on the dual listed stocks asset swap, just to give you a little bit of an idea. So on the JSE right now, you can go and buy ETFs that give you exposure to the American broad market, MSCI World Index, just for interest sake, 60% of the MSCI World is the US, NASDAQ, which is the US tech, etc., right? So those are ETFs you can buy. You can also buy direct holding in the Teslas, Volkswagen, Amazon's, 300 different trading names. Those are termed IDX futures. And then companies with offshore exposure, we already know. I mentioned AGL, but the more obvious dual listeds are Richmond, British American Tobacco, and Capital and Counties. All right, let's move then on. Advantages, potential pitfalls of offshore investing. Let's just stand still there for a second. So 0.4% means a couple of things, but one of the, remember, of the world GDP, South Africa is 0.4% of the world GDP. One of the things is that in some cases, we're not well covered. We don't have 100. Like if you look at, on the Bloomberg or the Reuters systems, and you go and look at analysts covering, let's say, a Facebook or a Amazon, or whichever one, choose one of the big ones. You will see there are literally, hundreds, and every bank and all independent analysts, etc., will have an opinion on a stock. So it's very, very well covered. The big economies, call it the developed economies, if I may put it in a bucket. It also means that South Africa, or the smaller economies, are sometimes not that well covered. So we may have, 10 analysts on a kind of bigger share, or there are ones that have more and less, depending on how popular the share is. But the point is, it gives opportunity. These big economies. So we want to taste the other 99.6% of the world, all this opportunity, but there are, definitely some complexities that you need to be aware of. So opportunity to offshore investing definitely gives you opportunity, but understand that the complexities are also there, and we need to discuss some of those and hopefully go through some of them today. Okay, risk-adjusted returns. I think that's a very, very important point. We need to understand that when you take rands, and let's make it easy and plain vanilla, and you take it into dollars, and you go and buy a S&P 500 tracker offshore in whatever, you open the offshore bank account, argument's sake, and you buy an offshore US market S&P 500 tracker in there, so very plain vanilla, nothing fancy. You think you have American equity market risk, which you do have. You have a couple of risks that you're already aware of. But don't forget the very first one I've already spoken about. Though you have a rand dollar exchange risk. So before you even invest in something, you've already put a certain amount of risk in your investment. And just if you need to bring your rands back here to use it now or sometime in the future, understand that that is a risk that you need to understand and live with. Okay. But all that I'm trying to get to here is this concept of risk-adjusted returns. I'm going to say it differently just to make sense. How many units of risk do I take to get 1 unit of return? Okay, and I'm not going to define either of those, because there are many financial models that you can now apply to, and ratios, the Sharpe ratio, the Trainer ratio, etc. So there are a number of different ways that you can measure this. But how many units of risk do I have to take to make 1 unit of return? Is that 0.1, 0.5, whatever the metric is, doesn't matter. I'm just trying to get to rational versus irrational decisions. So you're going to already see Bitcoin and I'm sure there's already at least a couple of guys and girls sitting on the edge of the seats to say, what is he going to say about Bitcoin? Nothing negative. All that I'm trying to say here is we need to understand the risk of whatever we get involved in. On the Bitcoin topic, Viv is doing a whole Bitcoin seminar or webinar series coming soon to your computer screen. So we're definitely not running away from Bitcoin or 100% against Bitcoin. All that I'm trying to say is, doesn't matter who you listen to. When they say you need to put all your cash and everything in Bitcoin, I think from a risk-adjusted approach, they might miss 1 or 2 principles that, if they're right, so let's say you put 100% in Bitcoin and Bitcoin goes to infinity, please invite me to your private yacht in the Caribbean. I would love to spend a couple of days with you there. But if you're wrong, understand that you have put 100% in you've only put 1 egg in your basket. You've put all your eggs in one basket and you didn't spread the risk. Same with the equity. You can easily look back at the last 5-10 years, equity performance on the JSE versus equity performance in the US, and go and look at the two and see that the US have vastly outperformed South African equities. And there are hundreds of reasons for it. But understand that when we look at these, we have to look at it from a risk-adjusted perspective. How many units of risk are we willing to take? Because Bitcoin might drop from 60,000 to 30,000, or US equity, the FANGs, Facebook, Amazon, Netflix, etc., might drop after their spectacular run the last couple of years, and especially the last year. So, and that re-rates 50%, and you've now put all your eggs in one basket. So I'm trying to get to a principle just to say to you, understand that any unit of performance or upside or percentage return you make carries a number of units of risk, and that has to have a balance. And then you can use all the instruments. I'm not against any instrument, but just understand that we need to look at it rationally. The next one is capital gains tax. Like in South Africa, you will internationally pay capital gains tax. Remember, we have a residency-based tax system, which means if you are a resident in South Africa, if you're considered a resident, and there's some rules, you can look at the Income Tax Act around it, but you will pay tax in this country. So that's what residency-based tax means. And one of those taxes is tax on capital gains. Now, there are 2 ways in which you can use this CGT principle. You will pay tax on gains internationally. Typically, there are some interesting structures that you don't, but that's outside of the scope of this webinar, at least. The point is, you will pay capital gains tax. And there are kind of two streams of thought that SARS allows us to use. Firstly, we can take the rand dollar exchange rate now and then, when we enter the investment, or we can multiply it at each point in time, and those both give you a little bit of a difference in terms of the capital gains amount. But so make sure you just ask your tax practitioner to calculate both to make sure you have the better of the two. But the point is, you still have the normal rules, right? 40% inclusion of your marginal tax rate, etc. So the normal CGT rules apply. Inheritance taxes. So just like we have, estate, we call it estate duty, death taxes. In South Africa, we're going to talk about that now. If you're in a different country, there may be inheritance taxes there as well. So you may have to pay, if you hold it and you leave everything to your whatever children, let's say, you may have to pay death taxes twice in that country and here, but we'll chat about that now. Guaranteed returns and elevated returns. Now, this is a big pitfall. I want you to please hear my heart when I'm trying to give you this, talk about this bullet point. Are there guaranteed returns out there? Absolutely. Are there, for example, structured products that give you guaranteed returns or guarantee a certain level or whatever? Absolutely. Are they backed by great counterparties? For sure. JP Morgan, Morgan Stanley, all these massive AAA banks in all over the world, actually. But so there are definitely good counterparties and good products in this space. But when you see a guaranteed return, or you hear of a massively elevated return, so something that's ridiculous, like 15, 20% per year on a bond, or stuff like that. Understand, elevated returns gives elevated risk. All right, doesn't matter how you skin the cat, elevated returns gives you an elevated risk. Understand, I'm not saying don't do the investment. Understand the dynamics. Again, risk-adjusted returns, right? Understand how many units of risk you're taking to get these units of return. And then guaranteed returns. I will always implore you to just go and dig into anything that's a guaranteed return. Just make sure that the underlying structure underneath it is a good one and from a reputable source. Because I've seen some horrors during the years. Advanced structures, there are lots of them. We're going to look at one or two of them next month in the next webinar in this series. But there are lots of advanced structures. A lot of them have their advantages, obviously, and their disadvantages, their pros and cons. Just make sure when you look at a structure, understand it. Don't just look at the one-page glossy brochure. You have to, unfortunately, work through the ugly 40-pager to make sure you understand what you're getting into. Because sometimes you move money out of your name, and then to dissolve it and back into your name might become ugly. So both an advantage and a pitfall if you don't know what you're doing, right? And then just the cost to transfer from us to a different domicile or a different currency. We'll chat about that in a few minutes. Next one, let's chat a bit about the structure. What is the best structure that in an offshore portfolio? Now, the answer, before you even start reading, the answer is there are many answers to this equation. Just for example, that third bullet point, the second last bullet point, 10% property. If you already have an investment property, and I used the example earlier in London, if you already have a a UK investment property, then you probably shouldn't add to property, because I think you have a decent approach already, or a decent exposure to property already. All that I'm trying to show you here is, when you look at your, whatever you hold, look at it holistically. It has to have some kind of balance in. There has to be that big word, what we always talk about, diversification. We have to not have all our eggs in one basket, right? So just what do I mean by that? And this slide, at least, I'm going to run through, because the art of asset allocation talks about a lot of these principles. So go and listen to the art of asset allocation webinar, which we'll talk about this in a bit more depth. But the point is, a balanced fund, the CISA, the Association of Savings and Investments South Africa, CISA, big body that runs a lot of what happens in our investment world. So in South Africa, CISA, they give us a bit of a breakdown of what a balanced fund typically looks like. So I don't think that's necessarily bad. If you look across all your holdings and you have roughly 60% equity, 20% bond or bond-like, a bit of property, some alternative investments, I think that's a fairly good mix from a diversification point of view. But things you need to kind of consider is, when we look at equity, is it growth, value, momentum? What is the underlying strategy we're running with? Are we staying developed, US, EU, Asia, or are we going more emerging markets? Or what's the mix between the two, at least, and for what reasons? Large cap or mid cap or small cap, how much of each? Those things are everything you have to have a look at in terms of equity exposure. Then I don't want to bore you, but let's say bonds, there's government bonds or corporate bonds. You can have developed market government or corporate bonds, or emerging market government or corporate bond. Which ones do you go for? Why? How many units of risk does that add to your portfolio versus how many units of return do you expect from it? Okay, and let's not even go through the rest, but the point is, have a look at the art of asset allocation. If you need more around this, or send me an email, or us an email, or pick up the phone, and you can always chat about this in more depth. But there needs to be a balance. There needs to be some diversification when you look at yourself holistically from the top down, and your wealth, or your assets under management. Inheritance tax. So let's start with inheritance taxes now, the death taxes, right? And I alluded to it already. And there's a couple of ugly names and some ugly definitions around it. And that is custody, and that probate, and that is situs. So all of these types of concepts that we need to understand. But I'm going to just make it fairly simple, because I don't want us to stop here for 5 or 10 minutes. The gist of it is, situs means in English, let's say, the site, the place where you have your whatever you're holding. Let's say it's a share. So let's call it, let's choose Facebook as an example. Facebook has a share registry. And where is that share registry? Somewhere in the US, right? So the situs, the place where you have that share, in theory, is in the United States. The US, for example, has what we call inheritance death taxes, situs taxes applicable. The other big one that we usually use is the UK. So just to show you here, look at the table down here. We have, we're used to the South African one. So your estate duty, the first 3.5 million rand in your estate is free from estate duty. And then anything thereafter is taxed at 20%. UK, we have a threshold of £325,000, and thereafter it is charged or taxed at 40%, and the USA 60,000. So you can see in the USA 60,000, you can fairly, UK is a little bit more lenient, but in the US, you can fairly quickly move over this threshold. And then there's a sliding scale. So you may have to pay the estate duty, right, of 20% if it's under 30 million estate, 25% if it's over 30 million estate. You can quickly have a double tax levied on you. I just see there's a question that came in here. Let me just see. Okay, this is very specific and it's more aligned to our stockbroking guys. Sorry, I'm going to, I'll get them to answer you directly. You're a little bit out of my world of expertise with this question. So apologies for that. I'm going to get somebody to give you a call and answer that appropriately. It's a little bit more specific to stockbroking. Okay, those are citus taxes, death taxes, right? And we need to understand, or you need to understand, that when you invest offshore, have this in mind, because the day that you pass away and you think you're going to leave X amount to your whatever kids, and then, you know, the USA knocks on your door, IRS, and they, oh, well, not your door, hopefully, but your whoever winds up your estate, and they say, listen, this is what your client held with us, and you need to pay that out. So understand that it can become a very expensive exercise. What is one? There's a number of solutions we kind of deploy to counteract it. And one of the biggest ones, I suppose, is to look for investment assets, especially when it comes to funds that is domiciled in non-citus taxation countries. So that's one of the ideas to, because you have lots of classes, right? Each class of fund, let's say company X balance fund, may have a class domiciled in America, one in Luxembourg, one in, let's say, Mauritius, because it's close. And then, you know, you rather go for the Lux or the Mauritius one in that case. But anyway, let's move on. Hopefully you understand the underlying issue that you need to be cognizant of. Managing Rand volatility. Rand volatility, we've spoken about now at length at the start. Just a couple of things I quickly want to note. I don't want to stand here, stop here for too long. But the first thing in terms of Rand volatility is the time frame. So again, I showed you that was a 20-year period, and there was this weakening of the Rand against the dollar over a 20-year period of roughly 3.5%. That dynamic or economic principle, the interest rate differential, should hold over time. There may be wild fluctuations, you know, due to whatever, political unrest, and then we weaken dramatically, or the other way around, like we saw, you know, the last, let's call it year, where the US is just printing money left, right, and center. They call it stimulus. They give it a pretty name, but it's printing money in its different shapes and forms. But they literally weaken their currency. I always just explain it to clients to say, you have a company and you own 50% and your partner owns 50%. Now you give another 10 shares away, or let's say another 8 shares away. So now you've literally diluted that same amount. So let's say it was 10 Rand. Your company was worth 10 Rand, divided by the two of you is 5 Rand each, right? So you're worth of that company is R5, and your partner's worth of the company is R5. Now you just print money, right? Print shareholding, another, let's say 8 shares of the same size. So now there's 10 shares. Did the company value change? No, but the amount of people that hold the same share size did change from 2 to 10. So now suddenly 10 divided by 10 is 1. So you've just weakened your value of that share that you hold. Same thing happening in the US. And what's the, we can talk economics for a bit, but the point is, one of the effects of that is it gives our rand a little bit of strength, and we saw that. So in terms of a time frame, the rand may move up and down due to whatever the external factors is, but over time we should see this weakening over a long-term period, like a 20-year period. We should see this weakening to the amount of the interest rate differential. So what am I trying to say? The easy way, and I know this is the cop-out answer, but the easy way to handle rand volatility if you're offshore is just to keep on holding, right? 10, 20, 15 years, a long period of time, and you should get rid of most of those volatility effects. The second one is what I always term buckets, right? We have a short-term, medium-term, long-term bucket. So the long-term bucket, we can move out there and forget it, same as the first one, the long time frame, right? So the long-term bucket, we can just leave and let it run. The short-term bucket, the medium-term bucket, maybe we can still go offshore, but let's say we go in stuff that's less aggressive. So we don't take all the blue chip tech stocks in America that has, crazy multiples these days, as we've seen them run over the last year especially, but a couple of years. We don't buy all of them, because if they start re-rating you and the rand dollar goes the wrong way, we might be shortchanged. So your medium-term bucket, still have it, or most of it offshore potentially, if it suits you, but look at maybe less risky underlying assets that you put in there. And then obviously the short-term bucket, if you're going to need the cash back in South Africa, you need to tread carefully. We just saw, if you took it out at 19, I remember sitting at a client at 1180 in the early in 2017, 1180, and some guy almost took everything out at that point. Luckily, we said, I explained the same principle I'm explaining to you now. The client held and had a big smile last year at some point, because there was still some of those funds, a large portion of those funds offshore. So it did recover. But if it goes to 1180, like in 2017, and life happens, we always think life doesn't happen to us, but life happens, and life happens, and you need to bring a large amount of cash for whatever reason. There can be a million reasons why you need to bring cash back, but you bring that cash back, and you have to now bring it back at 1180 at a 25, 30, 45% loss. Understand that. So back to the buckets, the short-term bucket, especially kind of your emergency funds or your living money, if you're retired, the next 2 or 3 years of the cash, to have it offshore is a risky move. And again, this is not financial advice. This is stating facts. Hopefully, you'll agree that's just the risk that you're taking on. Firstly, the exchange, rand-dollar exchange rate risk. Secondly, the currency risk, in other words. And secondly, then whatever underlying is, you have to tone down that risk dramatically. The other one is very short term, and it's more for business type clients, but it's hedging mechanisms. So you do get longer term hedging mechanisms, but they're typically expensive. The longer term, the longer you're out. So if I have to pick the rand for you now at 15, and you say, look, I want 15 rand, I have a plan, and it has to be 15 rand by next year, December, and I have to go and find the price for that in the market, there's too much volatility over a longer time period that can still happen. So it's going to be expensive to have that. But as I say, especially for businesses that import and export, and one or two of those clients, forward rate agreements is a nice one. They know in 45 or 60 or 30 days even, they need to peg a price, or they need to pay a supplier, or receive money if they've provided a service, whatever the case might be. But they don't want any funnies from a rand dollar perspective. You can peg that rate with a hedging mechanism like a FRA, a forward rate agreement. There are many of that. There are one or two others, but I think that's a bit too technical. I think that's good enough for the purposes of this presentation. All right, costs. Firstly, FX cost. So this currency exchange rate cost. It's one I needed to pay for a course I did 2-3 months ago, and I left it for too late. Usually I would just take it through the normal way, but in this case I left it too late, and I just paid with my credit card, put my details in, and it came back, and I should have actually probably queried it, but I didn't even query it. But they charged me over 3.5% for that transaction. Granted, it was a small transaction, right? It's a course, which is it was a couple of $1,000. So it's a smaller transaction in this world, at least. But 3.5% is a massive amount of money to pay just to get my rands to pay something in dollars. It's a world that you need to understand. But the gist of it is, you get fees, and then you get a spread. Remember, a spread is the willing buyer and a willing seller. There's always a willing buyer and a willing seller, and these two are different. They give you a different rate. And think about it when you sell your house. When you sell your house, you're a willing seller, right? And you say, I want to sell my house for whatever, 500,000 flat, for 500,000. And then somebody else comes and they are a willing buyer, and they say, well, I'm not gonna do 500. I'll give you 400,000. Do you want it? And you say, no, I'll go 20,000 less. I'll go 480. Then another guy comes in and says, okay, I'll go 450. Anyway, that difference between the willing buyer and the willing seller's price is what we call a spread. And you see that on any market. You can go on whatever, apps or share price right now, and you'll see the difference between the willing buyers and willing sellers as a spread. You need to understand what that amount of spread will be, because there are fees in that spread. If you trade right in the middle of that spread at spot, we call it spot, then I just see spread is, it's spelled correctly. Anyway, spread is a big component. So you really can't see the spread. So when you have a provider that tells you we charge you 0 fees, you need to understand what the spread looks like. And when you have a provider that says we're going to charge you at spot and add a fee or a commission or whatever, then you need to understand what that looks like. But don't just see a 0% something and think you're not paying anything. You will definitely be paying something. And the easiest way to see what it was is to see how much rands you got, and see how much dollars or pounds or whatever you took it to, and just divide the one by the other, and you'll see it was 1460. We were trading at 1460 that day, and I got 1490. And then you go and work out and you see it's a 1 or 2% spread or whatever. Anyway, it's a cost. I want you to understand the cost and not just move money blindly across without making sure you understand what it does. Then there are a number of fees depending on obviously the product. So as we said, there are so many products and they all call different fees differently. Different countries have different naming conventions, but there will be, if you have a fund or something like that, any type of fund or something that's managed, there will be an asset or a fund management fee. There will be advisory fees if there's an advisor somewhere in the process. There will be an administration or a platform fee. There will be custody fees. So some international banks allow you to hold cash there, but because the interest rates, especially in Europe and the US, is so low, some countries in the EU is even negative. They charge a custody fee. So there will be a fee levied on your account, and it's not big, it's 0.15%, 0.25%, depending on a provider. But the point is there will be a custody fee that you need to be cognizant of just to hold your cash there, even if it's just cash, but if it's in a structure or an underlying share or funds or whatever is in the line, the custody fee will be charged on the total value. And then very important, especially for this conversation, is minimum amounts. Understand that we have minimums here, let's say in stockbroking of whatever it is, 50 Rand or 100 Rand or 200 Rand, whatever the case may be. But they all funds, even to get into some unit trusts or whatever, they have minimum amounts that they're going to charge. So if you're under those minimum amounts, in terms of this, the commission percentage to get into that, it may be a lot. So you'll see, especially the more alternative hedge fund, the more exotic, let's call it the exotic instruments, like hedge funds and commodity products, etc. Those minimums can be quite big, $200-300. Make sure that when you do transactions, that the minimum in terms of a percentage of the amount you're going to invest in that specific product is not too high. So you don't end up paying 5, 6, 7, 10% just to get into the product because there's a minimum cost. Then the last thing in terms of cost you need to also, in my opinion, be careful of is upfront lock-in periods. There are and there may be tax benefits, and we'll touch a little bit on this in next month's webinar. But understand, and when there's lockup periods, 3, 4, 5 years, whatever the lockup period is, make sure that the reason you're going to that product is for the tax benefit, because those things typically carry a lot of costs. And there are a lot of commissions that may be rolled up because it's a 5-year product. Make sure you look straight through those products and understand what you're paying inside the products, especially when it's a lockup period product. But as I say, the tax benefit has to be greater than the cost benefit. Good. I see it's 1 o'clock. Very quickly, I think I was quite impressed that according to the poll, a lot of you knew what the single discretionary allowance and the foreign investment allowance was. But how do clients usually go offshore? You can take R1 million out every year, single discretionary. You sign a form and you can move it out fairly easily, no problem. No rules. The only thing is, remember, if you're planning a December expensive ski holiday with your family and you've already moved your $1 million, you've exhausted your discretionary money, right? You won't be able to swipe your credit card offshore, or you're going to get back and get some big penalties and surprises. So, oops, sorry. Just make sure that you keep any expenses that you're still going to potentially have offshore out of that amount, your discretionary allowance that you can take. Secondly, is you have to, if your tax affairs are in order, it's a fairly simple process, takes about 21 working days, but fairly simple. You need to give your assets and liabilities and just show where the money is. And you can't apply for 10 million, you have to apply for the specific amount in your bank account. So let's say that's 2 million, above the 1 million, it's single discretionary. Then you send it to SARS, they approve it, and then you get a PIN and you can take the money across. And then the last one is in very special cases. There are times where you can take out more than 10 million. Okay, good. Thank you for joining me. That is the end of my presentation. I appreciate your time today. Please join me for the next one. If there are any of the ones you've missed that you still want to have a look at, you can find those on our YouTube site. And this one should be uploaded in the next week or so to the YouTube site. But if there are any questions, please email, call, whatever if you feel most comfortable with, and we can answer and chat you through it. The one gentleman who's already sent a question, I will get our trading guys to contact you. But that's it from my side for today. Have a good Wednesday. All the best.